And good evening, everybody. I'm Michael Folagera. I am with logicalsignals.com and tradershelpingtraders.com. And this is the Elliott Wave update for the S&P 500 for Wednesday, May 26th, 2021. Not a whole lot to be updating tonight. The markets continue to trade in a very narrow range, and that does not really offer us any changes to our current analysis. I'm going to continue to look at this as a three-wave correction, an ABC correction. And it now looks like the C wave is finally back in progress, not large, but enough to bring us back down possibly to 41.75, which is where first support will happen. But more likely that we'll probably meet additional support at 41.67, which is where the 200-day moving average is. So wherever that ends up, if the market continues to decline, it will provide some support and could finish the move. But more likely, the most common area would be back down here at 41.52. And you can put that zone all the way down to 41.50 for that matter. And then once that is complete, should the market get down that far, my expectations would be for the market to turn around and to continue higher and to move to new highs as a fifth wave then unfolds. And that then will be in line with completion of the minor level fifth wave, which the market is putting in. Now, this is a very sloppy five-wave pattern, I will say, if it does pan out in that direction. But it's a finishing move. And often when a fifth wave is in that fifth wave position of a finish, in terms of it's a minor wave finishing an intermediate wave, finishing a primary wave as we head up. As that continues, you can see that you're just increasing levels of where this should finish. So it's either going to like whimper its way up to new highs, or we're going to see a blow-off style. That blow-off can still happen, in which case we might have to alter our count of this third wave. I mean, I can still be pretty satisfied with the degree that we changed, or that I changed yesterday, and that this would be a minor wave 5 up. But we might be really subdividing within the third wave. And then that still would point to much stronger new highs than what we have considered thus far. So for tomorrow, the market really will eventually have to break out of this range. The downside would suggest that we're going to get into this zone of support from 41.75 down to 41.50. That would be the area most likely to contain a small little wave 4 correction. If indeed we have to revert back to the previous count, which still kind of holds equal weighting, would be that this is A, B, and the market is finishing a C wave, and that would be the completion of the C wave there. Then, and in terms of then it's a B wave, because a C wave completing a B wave, then the market is dropping in the third wave of C down, and that should start to accelerate, should start to break below these levels and start heading back down towards that low. And we had worked Fibonacci support actually back down all the way to here. So it was around 4,000, and you could take it as low as 3,995, let's say. So we're going to let the market tell us, but those are the two views that we have. I'm not really looking for this other one. I'm looking for the market to kind of stabilize and finish its smaller correction and then continue to rally again. That seems to go along with that this market is being supported. So, you know, the Dow, the equity markets are being supported. The buyers are there, they're remaining strong, and they have something in mind that what should be happening. Now, they're not getting very far. They're holding it in a very tight range, but they remain. So each time that the market has tried to sell off, the buyers step back in and they just buy it straight back up. Either they're buying some on the way down, and then they're just buying it back up. And until we get either a stronger perception of why they're doing that, other than new money coming in and they just have all this faith in strengthening the economy, et cetera, who knows? But under Elliott, these are the two views that we can present. And Elliott does not make any notes on having influence by geopolitical events, news events, fundamentals from a particular company. Doesn't know anything. So it's a pure based on the structure of the moves that we've seen thus far and history. So it's more of a guide to the emotional personalities of people as they invest their money. And that's really what it gauges. You know, irrational exuberance, fear, all of those different things are really what Elliott and Fibonacci help us to wrap around and put a gauge on. So we have for tomorrow, looking for a little bit of additional downside. If the market holds 4150, plus or minus a little bit, then I would expect that the next wave up would begin and should easily carry the S&P back towards this high at 4212, 4213. That's where I would expect it to go without too much hesitation and without too many problems, and start to break above. That would signal that, okay, correction's over, now we're moving up. And the only thing that really stands in the way that the possibility is that the third wave is not complete, and that we're going to complete it back up here about 4,200, and then we're going to drop again, et cetera, et cetera. But we'll face that when we get there. Ultimately, I do believe that the market is going to go up and produce additional new highs, and likely top itself out somewhere between 4,275 and 4,300, or even above. We have had those Fibonacci extensions that measure all the way up. And so that continues to be in play. Downside, we do have coverage all the way down to this low and slightly below before we'd have to revert and take another very, very serious look at what's happening in the market and start labeling these highs as completion points. But we're not being told, we're not having any evidence that that is the case. So, but could it be out there? Of course. Things can happen in the news. Things can happen in industries that have been controlling the governments and the markets for decades upon decades upon decades. And that industry is oil and gas. And if you paid attention to the news that came out today, that came from Royal Dutch Shell, there was a major ruling by a Dutch court that Royal Dutch Shell has to cut their emissions by 45%. Then came another story from Chevron that the board has basically also declared that Chevron has to cut its emissions. Then you got another story that came from Exxon, that activists have managed, that the board is replacing several members with activists that are totally in favor of cutting emissions and changing protocols for how they want to do business. So those are three major changes coming in that favor climate change, obviously, but do some internal damage to the oil and gas industry. So we'll see how this all plays out. If things start to gang up, that's going to show that the market needs to change how it does and how it values and things that happen. Well, that's also going to, wind its way through the system and come out via movement on our charts. That's where I'm going to leave it for today. The next step will be Thursday, the 27th.